From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Monday the 18th, 3 p.m. in London, 10 a.m. over in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson, Alix Steel over in New York. Welcome, everybody, to Bloomberg Markets. Alex, the front end of the bond market starting to flex its muscles.
An unbelievable move that we've seen just over the last few days. I feel like it's really all about the UK and pricing in more rate hikes after Andrew Bailey spoke over the weekend, but it's felt everywhere. I'm calling it the hike heard around the world. I have hike in quotes because it hasn't actually happened yet. And you can see what's happening to the curve here in the U.S. 118 is where we sit, and you have the belly in the front end really selling off quite hard. You can see that with the 5-year up by about 3 basis points. The knock-on effect to the equity market, though, still relatively muted. The S&P only down 0.1%, and the cyclicals are the ones, no surprise, that are outperforming. You have energy, you have consumer discretionary, and you have financials as well. Oil still higher, that really helping to propel that part of the index higher. What's so interesting, Guy, and I'm sure we'll get to this over the next couple hours, is what's happening in the cable rate. You may have rates flying higher over in the UK, but you do not have that within sterling. The cable market, for example, not showing that, down 0.1%. We'll discuss what that means. Policy mistake? How do we interpret something like that?
It's really interesting because what we are essentially seeing is the market saying, you know what, we're in a position where we think both fiscal tightening and monetary tightening may actually have a negative effect on the market. It's going to be interesting. If we don't see progress in DC, could the US be seeing the same thing as well? The fiscal goes away, the monetary gets tightened. We are getting data out of the housing market. We saw industrial data that was a little weaker earlier on, Alex. Now we're getting data from the housing market, which has been rolling over recently and is now starting to show signs of life. So the National Association of Home Builders Housing Market Index, this is October data. So this is relatively new. This is a good read on what is happening. Pops back up to 80. It was projected to fall from 76 to 75, but we've got better numbers. So maybe signs of life in the housing market. We'll talk about the housing market a little bit later on in the program in a little bit more detail. Yeah, with breaking down the likes of what we're seeing from Zillow there. All right, let's get to those mounting inflation fears and just what they're doing to bond yields. Ira Jersey, Bloomberg Intelligence U.S. rate strategist, joins us now. Ira, it's the move of the morning. How much more upside is there to yields?
Yeah, I think yields can still go another 15 or 20 basis points higher from where we are now in the 10-year space. But keep in mind, we mentioned the inflation fears. That's not what the market's saying. The market's saying inflation is likely to be peaking basically now into early 2022 and then start to come down pretty significantly. So what you're really seeing now is real yields moving higher. So you look at 10-year real yields up 5 basis points, 10-year inflation break-evens down 1 basis point today. It's really the hawkishness of central banks that's pushing this. And I think those comments over the weekend from the Bank of England are one of the primary drivers, if not the primary driver of all of this.
Yeah, it's amazing. The UK and New Zealand both pushing things along quite nicely in that direction. Ira, thank you very much indeed. Ira Jersey of Bloomberg Intelligence. Let's talk about what is happening with Bitcoin, pushing towards all-time highs. ProShares preparing to launch its first ever Bitcoin linked. This is a futures product, ETF. We think that's going to come tomorrow. Let's talk about what impact this is going to have on the price action. As ever, do you front-run these kinds of things? Bloomberg Intelligence senior ETF analyst Eric Balchunas here to tell us what we can expect and what the details are.
Yeah, so this is a major step forward. That said, when you talk about, front-running or the price of Bitcoin, these ETFs track futures, and so that's going to limit their audience. We think they'll attract traders because the daily correlation to spot Bitcoin will be the highest thing out there. But that correlation will break down a little bit over the long term because they have to roll futures. And a lot of advisors are just not going to touch anything that rolls futures. They learned the hard way through VXX and USO not to mess with that market. That said, we do think there'll be a big hit with traders. We see maybe 4 or 5 billion in the first 12 months, but that's less than 1% of Bitcoin's market cap. So I think a lot of the euphoria and the buying of Bitcoin ahead of this, it's already been front run to a degree, I guess, is really just because the SEC has finally, after 7 years, started the process of opening up crypto to, anyone and everyone because ETFs are available so widely.
Eric, I know you've been waiting for this moment for a long time. Thanks a lot for that perspective. We'll break down some price action later on in the hour as well. Eric Batunis of Bloomberg Intelligence. Also kind of moving markets in the background here. We have a data overnight on slowing growth in China. The third quarter GDP growth missed estimates. GDP only grew about 4.9% versus 7.9% this time last year. Want to break down the numbers and what it means for the PBOC. Damian Sassower of Bloomberg Intelligence is here. Damian, what do you make of it?
Well, it's the activity data, right? Forget about the GDP print. We knew that was going to come in low, but it's really the bounce back in retail sales, which was largely driven by a lot of markets coming back online after the Delta variants and some of the outages we saw there. But look at industrial production, 3.1% year over year. That is pretty weak. And it's weakness in high tech. It's weakness in manufacturing that's really spilling over into the economy and really, bringing down the numbers. I think what we're going to be looking for is sub 4% GDP growth in the fourth quarter of this year. That should take full year GDP growth just around about 6%, which is fine. But, we're looking for the PBOC to come in. We're expecting a 50 bip triple R cut, but we may be waiting for Godot at that point.
You're channeling Alix Steel.
I am. I wait for Godot a lot.
Yeah, she spends a lot of time talking about this. Wait till you start saying bananas, then maybe you'll fully be in her camp. Damian, yeah, I think a lot of pressure on the PBOC right now, maybe to start taking action. It's interesting to see exactly how we're going to see the Chinese government maybe suppressing some of their recent shifts and regulatory onslaught that we've seen hitting a number of different industries. Damian Sassower, Bloomberg Intelligence, thank you very much indeed. Let's talk about what is happening in D.C. Democrats in Washington continue debating President Biden's multi-trillion-dollar economic plan. Senate Majority Leader Chuck Schumer getting an end-of-the-month deadline to get this all done. Then there's the whole question around what's happening with U.S. sustainability and environmental policy. Is the president going to Glasgow? Our Washington correspondent Anne-Marie Hordern joins us now with the latest.
Well, Guy, it's the start of a new week, and we do have the House and Senate coming back this week. So as you say, there is going to be a lot of debate regarding this reconciliation package. And one of those key themes is the climate aspect of that reconciliation package. North of $100 billion was supposed to be used to set up this clean electricity grid. The idea was to give money for utilities to switch from oil, gas, and coal to things like solar and wind, and potentially just lowering those emissions, doubling the cleaner use of electricity by the end of the decade. This is a huge win for the Biden administration. Supposed to be on the international stage, a good point, going into Scotland if he can go in empty-handed or not. But we learned over the weekend that Senator Joe Manchin from West Virginia, which is definitely a coal-heavy state, says he cannot sign up for this. So it's a huge blow for the Biden administration, both domestically when it comes to this economic agenda, and really he ran on a climate platform, but also internationally if he goes into these talks with really not having the goods to meet those standards.
All right, Bloomberg's Anne-Marie Hordern, thank you very much for that. And Colin Powell, the first African-American to be U.S. Secretary of State and Chairman of the Joint Chiefs of Staff, has died. Powell's family says he died today due to complications from COVID-19. Powell's family says he was fully vaccinated and was being treated at Walter Reed National Medical Center. He was born in Harlem to Jamaican immigrants. Powell served in public office for 4 decades. He was 84.
We've got some clear speed bumps. The central banks are one of them. But at the end of the day, the balance sheets are fine. The consumers are in great shape. The appetite is very, very healthy. And I think that's allowed investors to look through some of these supply chain issues.
That was Lori Calvasina, RBC Capital Markets, head of U.S. equity strategy, speaking to Bloomberg earlier. And you got yields higher, but bulls are still there. Morgan Stanley says they still see mom-and-pop investors to most extent buying the dip. Joining us now is Lisa Shallett, Morgan Stanley Wealth Management Chief Investment Officer. Lisa, you got these higher yields anywhere you look in the curve, really led over by the U.K. Can you still buy equities right now?
So look, we're very, very cautious. And in particular, we're cautious on the index itself. We like to be active stock pickers because we do think that over the past 3 or 4 months, we have seen a rolling correction, particularly in small caps and value-oriented stocks and cyclical stocks. And so we're picking stocks there. But as far as the index goes, we've been trying to make the point to investors that this is an index that's unbelievably concentrated in 15 to 20 names that are very, very expensive and are very dependent on low interest rates for longer. We're not sure that interest rates are going to be lower for longer. And so we see these indices as vulnerable.
How vulnerable? And Lisa, is there a tipping point on rates? We're starting to see these incredibly negative real rates. The gap is closing, i.e. we're seeing rates climbing, the nominals obviously vis-a-vis inflation. But is there a tipping point that we need to worry about?
Yeah, look, first I would say, we've been looking for the index to correct, somewhere between 10 and 15%. From the Labor Day high, the pre-Labor Day high, we at the lowest points we're down about 6 or 7%. We've retraced a good portion of that. Now we're only off, that peak by about 2%. But as far as rates go, the real key thing here is real rates. And actually last week, most of the action in nominals was driven by inflation break-evens, and real rates actually retraced, giving some of these expensive long duration tech stocks, some breathing room. We're not entirely sure that a lot of the buy the dip investors who are chasing some of these names that have worked for so long understand that vulnerability. And so I think they're not going to be convinced until they hear some of the earnings announcements. And this is where we're not as convinced that these companies are going to be immune to what we're seeing in the environment in terms of pressures to margins.
Based on that, though, speaking of Lori Calvasine of RBC, she also mentioned in her note this morning, which I thought was interesting, that there's been so many downgrades to earnings for industrials, for example, that sort of the bad news is already baked in. So I hear your point about the supply chain issues, the higher costs, et cetera, but is there a sector where we're already pricing that to most extent?
Yeah, so I think that there are several sectors, as we've talked about. Financials have really, priced the curve pretty consistently, have priced fundamentals like loan growth. Industrials have absolutely priced these supply chain disruptions and even things, that we saw last week, like the strike at John Deere and the potential hit to margins there. On the other side of the coin, our sense is that, companies like Apple that are clearly being impacted by supply chain pressures and are signaling that are getting a pause and a buy from investors. And we think that is potentially dangerous. These companies, as great as they are, as great companies, may not be great stocks because people are just baking in too much optimism that they can defy gravity.
Lisa, can we talk about the relationship between the consumer, how the consumer feels, and what is happening in the stock market? You talk about this in your note to clients. We've started to see evidence that maybe the consumer is slowing down. We got a little bit of divergence in the retail numbers back end of last week in the University of Michigan data, but nevertheless, there is evidence that consumers are being cautious. How is that going to translate into the equity market? How should I think about that relationship?
Yeah, so I think it was interesting, as you pointed out, Lori, the prior strategist, she talked about investors looking through supply chain and looking through transitory inflation. It is really clear that consumers are not looking through these issues. There is a big divergence between investor confidence, CEO confidence, and consumer confidence. Here we are in an environment of 4.8% unemployment within 18 months of a horrific recession, and we're seeing consumer sentiment continue to decline. That ultimately is going to translate into some kind of disappointments on the demand line as consumers decide, hey, I'm cautious. I see uncertainty ahead. I'm not sure what's really happening with this job market. Even if I get wage gains, I'm not sure my wage gains are going to outpace inflation. And I'm not sure that my wage gains are going to outpace the price increases that all these companies claim that they're passing through.
So, Lisa, put this all together for me. So over the weekend, we hear from Andrew Bailey of the BOE. Seems to be like doubling, quadrupling quintupling down on a rate hike. The expectation is moving much closer. Then you go to the U.S. and you see 2 years up again, about 2 basis points. You see real rates moving their way higher as well. You see some buying coming in to the back end of the curve. I just wonder, do you think the Fed's going to be pushed into a policy mistake then? Is the market too aggressive in pricing in what the Fed might do?
No, I actually think that the market is starting to actually price reality, and that if the Fed moves at this point, we don't see it as a mistake. Our view is that the policy mistake from here is that Powell digs his heels in, continues to want to be too patient and too dovish, and not react, and keep the liquidity flowing into this market at just absolutely record levels that are sustaining, these inflows that we continue to see into the market. So our sense is that the bond market is starting to price a better reality, and it's the stock market that now needs to catch up to what does it mean when you actually have higher real rates and a flatter yield curve.
Yep, and it's interesting to see what's happening on the fiscal front as well. So you could have potentially higher cost of money and less fiscal. It's going to be interesting to see what that combination looks like. Oh, yeah, sorry. We potentially could be living it here in the UK. Lisa, thank you very much indeed. Lisa Charlotte of Morgan Stanley, greatly appreciated. Alex.
That was pretty snarky of you, Guy. That was definitely a little dig there.
Well, it's the way we're going. I get them.
You're right.
Andrew Bailey is not mincing his words. He is being absolutely unequivocal in the fact that he is now looking in the direction of rate hikes. The Chancellor of the Exchequer, we're going to hear in the budget fairly soon. He's being pushed around by Boris Johnson. Boris Johnson would love to spend some more money, but the Chancellor is not going in that direction. We may see some wiggle room around energy, but you could have fiscal and monetary tightening at the same time.
Yeah,
Could
and
be
also
interesting.
higher energy prices. Yet another energy supplier just announcing that they're not going to trade anymore. So I don't envy you guys at all. Okay, we're going to hear more about the markets and how they view inflation and how the big guys think about inflation at the Milken Institute Global Conference over in Los Angeles. We're going to be there live over the next few days, and during these 2 hours, we're going to be speaking to Barbara Humpton, Siemens U.S. CEO, Scott Minerd of Guggenheim, Howard Marks of Oaktree, and much more. So stay with us for that, Guy.
Yep, we'll look forward to that. We're also going to be talking about what's happening in detail in the U.S. housing market. We saw the NAJB data at the top starting to tick up a little bit, but Zillow getting out of the house flipping business. We'll find out why. It feels like a pause right now. The market's not taking it too well, as you can see. The stock really down quite sharply on the back of it, but it's been declining for a while, which I think is interesting. We'll talk more about that in just a moment. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest stories in the news right now. I'm John Hyland. It's a Netflix show everyone is talking about. Squid Game is driving the company's shares to outperform its streaming rivals, as well as other technology peers in the months since the series was released. The show has now boosted the stock's market value by $19 billion since its launch on September 17th. And China is considering asking media companies from Tencent to ByteDance to let rivals access and display their content in search results. Bloomberg has learned China is considering the policy, which would be a big step in Beijing's campaign to break down barriers among the company's internet giants. Tech companies have already been warned to open their so-called walled gardens by allowing links to rival services. And shares of Tesla are staging a comeback today. Investors are signaling that they expect the Elon Musk-led electric car maker to navigate the crippling semiconductor shortage better than rivals that have been severely disrupted. Tesla stock is on its longest winning streak since before the COVID-19 pandemic roiled markets. The company will report its third quarter earnings results on Wednesday. And that is your Bloomberg Business Flash. Alex, Guy.
All right, John, thanks a lot. Really appreciate it, Guy. You know what I want to know also Tesla has? Tesla has some Bitcoin, and Bitcoin is near a record.
Yeah, do you reckon you can draw a line between one and the other? Maybe. But I would have thought actually the fact that it's actually been delivering cars and has basically been outpacing expectations on the sort of the mechanics of getting cars to customers, that seems to be a big driver.
Yeah,
but if you take a step back and think about the kind of the narrative around the fact that higher rates should be negative for these kinds of tech stocks, Tesla seems to be still performing pretty well. The money's still flowing in their direction.
Right, because I feel like if we see any stimulus anywhere, it's going to be in this area for sure, at least in some capacity.
Well, maybe.
Yeah.
Maybe Senator Manchin would have a different view on that. We'll wait and see.
True, but maybe there's some horse trading there, or maybe they're closer to a deal, and that's why we're coming down to the brass tacks. I don't know.
Yeah, Zillow's stock under pressure today. We're actually seeing some fairly positive housing market data, but Zillow long houses and is taking the rest of the year off from buying any more. It's basically decided it needs to whittle down its record inventory. Let's figure out exactly what is going on here. The stock's been on a decline for a while. Bloomberg's Dave Wilson looking at the numbers.
Well, Guy, I mean, it's a situation that a lot of other companies are facing at this point because, when Zillow buys homes, they fix them up and then resell them. It's the fixing up part that's the issue. They need labor. They need supplies. They're having trouble getting both. So they've decided to put their business on pause and focus on the houses that they have, especially after buying more than 3,800 of them in the second quarter. That's twice as many as they bought in the first quarter. So they really did, pick up their purchases at a time when arguably the U.S. housing market was cresting a bit. So, it's a matter of what they do from here, because if you go through the numbers, you find out they make close to 6% on the houses they sold in the second quarter. But, there are a lot of bits and pieces to the puzzle. They spend more than $320,000 a house. At least that's what they did when they were buying those 3,800 homes. Spend money on renovations. They have holding costs, finance, selling costs, put it all together. And they've got more than 3,100 homes in their inventory at this point. So a lot to work through. And they've really taken on a whole lot of debt to finance all this as well. They're up above $3.1 billion. At least that's where they were at the end of their latest quarter. And they've sold bonds twice in the past few months to help pay for all these houses they're buying.
Hey, Dave, is Zillow's issues or buying halt having any spillover effect on rivals here?
What's interesting is if you look at the shares of some of those companies, they're actually moving higher at a time when Zillow is coming down. So maybe people figure that, you take a competitor out of what they call the iBuying market, where it's all kind of based on these online appraisals, and maybe they'll have an easier time. We're talking about open door technologies and OfferPad solutions, OfferPad being much smaller. But nonetheless, I mean, it's all about the competition. And in this case, specifically, the online buying and selling competition.
Yeah, no kidding. All right, Dave, thanks a lot. Bloomberg's Dave Wilson joining us there. All right, coming up, we're going to follow the story from the morning, and that's how companies are navigating the chip crunch. You had some earnings over in Europe that talk just about this and what the problems are. Next, we're going to head over to the Milken Institute Global Conference and hear from Barbara Humpton. Siemens U.S. CEO will be joining us next as we continue to deal with a huge rise in global bond yields here and real rates inching higher. This is Bloomberg.
It's really a matter of both chips and ships. We have a shortage of e-components, and we see the delays in the shipping industry and the congestions in the ports that probably intensified during the quarter. We saw the biggest impact in September, and that set us back at least 150 million in the quarter.
Chips and chips, that was the CEO of Philips, Frans van Houten, speaking to Bloomberg a little bit earlier on today. Alex, this is the problem. But the question is, has it been priced? You were talking about this a little bit earlier on. The industrial sector has gone through quite a significant repricing based on the fact that we know that there are issues. Have we priced in enough? That, I think, is the question that I think we're still trying to figure out the answer to.
And I think that the analyst response and the stock response, I think, are quite interesting to Philips, because the analysts were all like, yeah, we expected this, makes sense. It's not a demand thing, it's a supply thing. It's already priced in, but clearly the stock is down 3.5%. So how much more does it need to be priced in? And I wonder if now we're dealing with a duration issue, that like how long is how you have to price.
I think that's exactly where we are now. There was this expectation that kind of, as we came into the end of the year, a lot of this stuff would be resolved, and as a result of which we'd head into the next year, maybe with a little bit more clarity. Yeah. But more and more companies are saying that's not going to be the case. You hear what the big shippers, like A.P. Moller-Maersk, are saying. They're expecting problems well into next year. So maybe we've just got the duration wrong on all of this, and maybe it does carry on for a little bit longer. Not a little bit, a lot longer.
Maybe it'll be more like chips, ships, and ports or something next time. But let's stay with the supply chain for a second.
That doesn't work, really.
It doesn't, I know, but I tried to make it work. I want to head over to the Milk Institute Global Conference right now. This year's gathering is focused on those disruptions, plus innovations brought on by the pandemic. And Bloomberg's Caroline Hyde is with Barbara Humpton, Siemens U.S. President and CEO. Caroline, I'll hand it over to you.
The perfect voice, Alex, following on from your discussion with Guy. Chips, ships, Siemens knows it all intimately. 40,000 employees as well. We can talk about some of the labor issues that we've got going on. Barbara, it is wonderful to have you here. And you're a woman who's not only been looking to the White House, discussing with them, helping fine-tune and react to the chip shortage, but you're a woman who also is dealing with, you know, a global supply chain that you help foster. When people could talk to you, because I got people asking me on the weekend, I can't imagine how many of your friends are asking you, when people say, look, how long is this going to last?
Yeah.
How long do you say?
I say this disruption is going to be with us for a bit. And I've heard predictions of, you know, through 22 into 23. The bright side of this is that it's bringing out a lot of innovation and creative work. I'll tell you, during the pandemic, our supply chain professionals were true heroes, really looking to diversify our sources of supply, using risk management techniques in order to keep our businesses up and running, and now using predictive analytics. So we've been very, very well supported by our supply chain team through it all, and we are a vital part of the supply chain ourselves, and we know how vital it is that people get what they need.
When you're managing things here in the US, and of course Siemens is a global engineering giant, but when you're looking at the US in particular, what innovations have worked? How at the moment, they're not working quickly enough. Everyone's saying that the infrastructure isn't there. Are we right-sizing in any way?
Well, I'll tell you, one of the major trends we see going on, we call globalization. So, you know, during the pandemic, we realized we didn't have access to all the supplies we needed here in the U.S. Our 40,000 people here in the U.S. were absolutely focused on helping their customers ramp up production capabilities so they could meet demand. You know, whether it was making masks or whether it was working with the FDA to speed up the process for approving new devices and medications. So we've been engaged with our digital tools, our hardware tools, in order to really help innovation here in the U.S. But meanwhile, that same challenge is being faced around the world. So what we think we're headed into is a moment when we'll be doing global innovation and deploying those ideas out for regional implementation.
So globalization isn't dead?
Globalization is definitely not dead because we know that there are different capabilities and talents around the world. By the way, my global colleagues look to the U.S. for innovation in digitalization. So we all know that we've traditionally built up specialties, but we also know that we now need to ensure that we're able to produce close to the source of demand.
So when you were with the White House, when you're looking at how to address the chip shortage in particular, are you advising we need fabs here in the United States?
Absolutely, and we are huge supporters of the CHIPS Act for just that reason. You know, the simple fact that we used to produce semiconductors here in the U.S. at a much larger scale and don't now.
But at a higher price.
Well, true, but what we're finding is with today's digital tools, and I'm happy to say we are working in every aspect of the chip supply chain to bring in tools to help people model the processes, model the flow, model the end use, and what we're finding is that those who use chips now, understanding the scarcity, are finding creative ways to engineer in more standard chips so that there's less customization in the chip process itself. All of those things are going to help alleviate the issues.
What alleviates the issues right here, right now at the Port of Long Beach when it comes to truck drivers, when it comes to, you know, is that all about automation? Is that all about AI to a certain extent? Or is that about a labor shortage?
It's all of the above, Caroline, and you know, it is all hands on deck. You know, just coming back to the chip shortage for a moment and seeing how all this ties together, what the U.S. government is putting into place is sort of an early warning system, asking industry to speak up and be open about the challenges they're facing, because we can only fix the problems when we can find them.
I mean, you're a woman who thinks deeply about your talent base, about understanding what they need at the moment. You yourself very much trying to find that balance yourself as a grandmother, but as a working professional. Your 40,000 employees, what are you saying to entice them, to keep them at Siemens, to ensure they're not being lured elsewhere when well, everyone's desperate to keep their talent.
Everyone has potential. And so at Siemens, a couple of things we're doing. One is we are a purpose-driven company. You know, there have been so many tech resources that have been put into entertainment and retail, et cetera. We're actually devoting technical expertise to the Internet of really big things, really changing the world around us. So we have a purpose-driven workforce, but at the same time, what we have to do is empower them. Huge focus on recognizing that lighter frameworks from global and from corporate is better for unleashing the power of our workforce, and then having a growth mindset. We've been hearing a lot about the great resignation, and what I'm hoping is that we can turn it into the great reassignment. If we have people who would like to try doing something else, well, there's lots of ways to take new roles within the company and stay fresh, stay engaged.
Here at Milken, you take to the stage, already been on the stage yesterday, you take to it once again. Are you filled with optimism here? What are you worried about when you're speaking to all of the people that finally we get to do this face to face again? What is your number one concern?
Oh, well, I'm a natural optimist. So, and my core belief that it is in times of disruption we have the greatest opportunity to shape the future. So what I want to do with an audience, yesterday I was in front of a group where I was told afterwards $32 trillion worth of assets under management, right? So think about that. Where should they be putting their capital? And what I want to see them do is not build back to the way things were, but to actually think about the future and recognize that they can help fund the more sustainable, the more resilient future that we have ahead of us.
Always opportunity within some of the issues that we currently face. Barbara Humpton, joy to have you with us. You'll come on stage in a moment, of course. The US CEO and President of Siemens. Guy, back to you.
Caroline, thank you very much indeed. Nice interview. Barbara Humpton, Siemens US CEO, and Bloomberg's Caroline Hyde at Milken. Something really interesting is happening in the bond markets. What you are seeing is a shift higher in front-end yields, sort of 2s to 10s. But when you get out to the back end of the market, Alex, what we're now seeing is yields falling, particularly in the United States in the 30-year area. The Fed's said to be in the market, so we continue to get this flattening of the curve, which has been ongoing for the last few days, and today, in some ways, accelerates.
Yeah, and in many ways, that's what you expect to see when you're worried about something like stagflation. You have inflation moving the front end because the Fed may hike, or there might be some tapering sooner than we think, and the back end gets weighed down because at some point you're going to have slowing growth because of that hike, and that seems to be what is playing out within the bond market right now. Something that is also kind of waiting in the wings here is COVID. We're looking at boosters here in the U.S. You're also looking at potentially another Delta Plus variant over in the U.K. You got cases surging there due to that mutation. We're going to break all of that down, and plus COVID treatments that are in the pipeline with Alexander Hardy, Genentech CEO. He'll be joining us next. This is Bloomberg.
This is Bloomberg Markets. I'm John Hyland, and you're looking at a live shot of the principal room. Coming up, David Hunt, PGIM Chairman and CEO. That's at 2 p.m. in New York, 7 p.m. in London. This is Bloomberg.
So the finance industry's out in California. The health industry's top players gathered in Boston for the health conference. They're going to be discussing the latest innovations in the sector. A lot has clearly changed over the last 2 years. One company that is firmly there, Genentech, remember, it has received FDA emergency authorization for its COVID-19 treatment for hospitalized adults and children. Alexander Hardy is Genentech's CEO and joins us from the conference now. Alexander, thanks for your time today. Look, you guys have been both feet involved in what is happening during the pandemic. As you start to think about what the post-pandemic world looks like, how different do you think what you do will be, and how different do you think the life sciences industry will look as a result of what we've all just lived through?
Well, Guy, first off, thanks very much for having me. Yes, COVID will absolutely have changed the life sciences industry, and for the better. We will work faster and more focused in deeper partnerships and make a bigger difference. I mean, I think COVID has been a rallying cry for the industry. We've all been focused on fighting this pandemic, and it's catalyzed a huge amount of energy and results. And I think one other angle I would say that I think is a positive change for the industry is we've seen healthcare, the inequities in the healthcare system. And that's a call to action for the industry. We've got to make sure we do inclusive research, make sure that the drugs that we're studying are studied in all populations, and we make sure that all patients have access to the innovations that we're producing.
In the meantime, if I just take the flip side of that, Alexander, is that a lot of people put off medical care during the pandemic, and I'm wondering what you're expecting in terms of a surge in particular diagnoses for that, disorders that come out of that. How are you guys prepping over there?
It's a very good question, and we see it as a big issue. We're very much focused in oncology, and that's been very, very concerning. It's I think a surprise for many of us to see how much cancer diagnoses and initiations of treatment were impacted by the pandemic, and in fact, they're still not back to baseline, to pre-COVID levels. So we do expect patients to come back in, to get diagnosed and treated. The thing that really is a deep concern for all of us is, how many patients will be presenting later on in their cancer journey and potentially will have worse outcomes as a result. So I think this is a rallying cry for the industry, and we're joined with others right now, encouraging patients to get screened, to get diagnosed. It's so important in cancer to catch the disease as early as possible and treat.
Do you think the regulatory environment has changed as well? I think we know that the regulatory environment has changed. Regulators have moved relatively quickly to approve drugs. We've seen quick trials. We've seen, obviously, a lot more flexibility. How do you think the regulatory regime is going to look post-COVID? You're involved in Alzheimer's as well. We saw what happened earlier this year, a more flexible approach being taken to Biogen's therapy, a lot of controversy around that. What do you take away from what is happening on the regulatory front, and what did you think about your business and your approach to Alzheimer's as a result of what happened with Biogen?
Well, Guy, I think it is one of the areas that absolutely has changed as a result of the pandemic. I mean, the level of collaboration with the FDA has been really extraordinary. We've had 10 treatments we've been exploring for use against COVID. We now have 2 with emergency use authorizations, including the one you mentioned at the very start of the segment. And that dialogue with the FDA has been excellent. I think the ability to share data when it's available and having these rolling submissions has been enormously powerful. And also in terms of endpoints, and you were referring to Alzheimer's, I think the use of surrogate endpoints and then confirmatory data subsequently in terms of the hard outcomes, that offers so much possibility to bring treatments, meaningful treatments to patients sooner. So I think these are all things that are heading in a very, very positive direction coming out of COVID and in partnership with government and particularly the FDA.
So have you discussed asking for accelerated approval from the FDA?
We're in discussions with the FDA. What is very important to us is we have 2 phase 3 studies for our lead molecule in Alzheimer's, and we will produce cognition outcomes, which of course is what everybody wants to see. The patient and the healthcare system wants to see, does this have a result in terms of changing the rate of cognitive decline in Alzheimer's. So we want to make sure we sustain those studies and read those results out, and that's a priority for us.
One of the more negative aspects of the pandemic is that maybe it's becoming a little harder to recruit people for trials. What has your experience been there?
We have a very broad portfolio of drugs in lots of therapy areas. In fact, in some therapy areas, like our drug for COVID that you mentioned at the start, actually we had some of the fastest studies in our history. And this wasn't just about patient recruitment. We managed to actually design the studies, implement them, and all the way from the data closure when the studies closed to the filing, we broke records. So I think this actually shows the possibilities coming out of COVID. And we've done many other things. For example, we now have remote data capture, remote studies, where patients don't necessarily need to go into a hospital to receive the study drug, or to go into the hospital to get certain types of tests in terms of their outcomes or their side effects. They can do these things remotely. The possibilities, COVID has accelerated our openness and regulators' openness to using new approaches.
All right, Alexander, we wish you a lot of luck. Thank you so much for some of your time today. Alexander Hardy, Genentech CEO, thank you very much. All right, coming up, we are knocking on record's door. Bitcoin marches higher a day before the debut of the first futures ETF. New York, though, cracking down a bit. We're going to break it down with one of the first market makers in crypto assets. Scott Freeman of JST Capital will be joining us next. This is Bloomberg. Well, Bitcoin and crypto stocks flying higher today as investors await the debut of ProShares Bitcoin Futures ETF, which reportedly could come tomorrow. Joining us now, Scott Freeman, co-founder and partner of JST Capital. JST Capital is a financial services firm specializing in the digital asset market. Scott, basic question. Let's pretend we get this futures ETF that's going to launch tomorrow. What does that do to the industry?
Yeah, we think it's great for the industry. We expect it'll increase demand. It'll give access to many more players in the U.S. in particular. So for those of us who have been in crypto for a long time, this has been a long time coming. So it's really good news for the crypto ecosystem and more specifically Bitcoin.
How do you think how do you think pricing is going to react, Scott? As you say, we've been waiting for this for a long time. There's a saying in markets, sometimes it's better to travel than arrive. We're about to arrive. What do you think the price is going to do?
You know, long term, we're bullish Bitcoin. Bitcoin is a volatile asset, right? So it's going to go up, it's going to go down. And people who are interested and going to be buying Bitcoin need to be comfortable with the volatility. But we think a year, 2 years, 5 years from now, Bitcoin will be substantially higher than it is today.
What do you think is going to be leading that? I mean, in order for that to happen, you're going to have to get these big institutional players come into the market. There's going to have to be more liquidity in certain areas. You're going to have to be able to broaden that investor base. What vehicles do you think are going to be most helpful in doing that?
I think for U.S. investors in particular, I think the ETF is going to be huge. I think it'll allow people, retail investors in particular, to start to get into it more easily. They'll be able to use their existing brokerage accounts. And I think it's a great vehicle for parents, for grandparents who want to start investing for their kids for the long term. It'll be very, very interesting. But I think to date, Bitcoin really has been driven by retail demand in Asia. We think that'll start to change a little bit, and more U.S. investors will get access to it.
So, Scott, you think this is now a market that is capable of absorbing widows and orphans? That's kind of where we are now. It's that mainstream.
You know, this is not something where we encourage anyone to put their life savings into Bitcoin. It's a very volatile asset, but to have a small portion of your portfolio, if you want to invest for your grandkids and want to put 5% of their college fund into Bitcoin, that's not a bad thing to do.
God help me if my parents wind up investing in Bitcoin. But as you say, having this ETF futures contract is a good thing in terms of just getting it out there to make it more investable. It's been a long time coming. It's been 7+ years. Like, I had a kid in that time. Where do we go next? Like, what kind of asset diversifiers are we going to find that are going to broaden that investor base?
You know, we think that over time, there'll be other assets in crypto as well. We think ETH is really a nice asset. We think it makes a lot of sense if you allow a Bitcoin ETF to allow an ETH ETF. I think a year out, maybe you have a basket of cryptocurrencies. I think this is just the beginning, right? Again, those of us who've been at it for a while, there's just a huge opportunity in this space. The crypto is not going away. Yeah. And I think, people realize that.
Scott, do you think people understand the differentiation between Bitcoin and Bitcoin futures?
I think not as much, but hopefully the ETF will start improving that level of education. I think there will be a discrepancy in the pricing, which we do see in futures and the cash markets. But what you get with the ETF is just easier to own. You don't have to worry about wallets. You don't have to worry about security. It's just it fits better into the investment ecosystem in the U.S.
Scott, real quick before I let you go, how do you invest in Bitcoin right now? Do you buy at this level?
I think you do, but it's got to be a long-term investment. Maybe not your parents, but maybe if your parents want to set up an account for your child, I think it's not a bad idea.
Yep, things go up, things go down. Scott, great stuff. Thanks for the analysis. Really appreciate your time. Scott Freeman. of JST Capital. Greatly appreciated. I want to flag something that's coming up tomorrow. It's a conversation that has got so many aspects to it. The British Prime Minister, Boris Johnson, sat down with Bloomberg editor-in-chief, John Micklethwaite. They had a wide-ranging conversation. There's a lot for Boris Johnson to think about right now. Clearly, COP is coming up. That's going to be a huge focus. But there's all kinds of other aspects here in the UK that are front and centre, I think, for the global economy, Alex. Because Boris Johnson is Teflon at the moment. But the UK economy, what is happening with COVID, we've got a huge number of cases here. You've got the Delta Plus variant. There's a lot of headwinds in Boris Johnson's face right now. But as I say, they seem to be just whistling past him.
Yeah, I just wonder at some point how long does that last, particularly as you point out, the energy crisis is not abating anytime soon. It's going to be really interesting to see how they manage that in the interview.
Absolutely. European closes next. This is Bloomberg.